Hello, today we're talking about moving averages. As you can see, this is the only indicator I use in my trading, except for the trading volume indicator, but that's a default basic indicator that everyone uses. It's impossible to trade without volumes, that's clear. Well, technically you can trade without moving averages, but I don't do that because they help me in three ways. First, they help to fundamentally understand the direction and strength of the trend. Second, they help to identify strong levels where potential market players might start buying or selling. And thirdly, they themselves sometimes give signals about the possibility of entering or exiting certain transactions. And these three aspects, these three factors, we'll break down today. First of all, let's start with the fact that if you go to TradingView, as far as I remember, the free version doesn't allow you to set an unlimited number of indicators, and I think even the paid version has a maximum limit. But I'm not sure how many, I haven't checked, I don't remember. But if you want to set a lot of moving averages, like 15 indicators, they just won't let you do that if you have the free version. Here's a hack. As you can see, I currently have 4 moving averages set up. These are the 4 colored lines running parallel to the price. You can set them up with just one single indicator. Here, we click on indicators and choose not the moving average, but the moving average ribbon. And in this one indicator, emery bone, as it's called in English, you can set up, as I understand it, up to 4 moving averages. So I actually have 4 of them set up. I use all moving averages as SMA, which stands for simple moving average. Not exponential, not volume weighted, no. A regular standard moving average. I use them, of course, based on the closing. I don't know a single person who uses them based on any other indicators. The values are 50, 100, 200. 1,000 is just for interest. You can do without that little black one. So for trading, you only need 50, 100, and 200. I sometimes use 1,000 just to observe. It's interesting to see what the average price was over 1,000 periods. So what does a moving average actually represent? As you can see, all the moving averages are following the price. There it goes. One moving average is heading up, the second one a bit later, the third one is also rounding off, and the fourth one is just barely lifting its nose up. See? They approach the price with different intensity, with different strength. How does this work and why? So this value of 50 is the number of candles, including the current one. So 50, there it is. The green one with the setting of 50 means that over the last 50 candles, the price was, on average, at what level? Right there. So when this candle was forming, the average price over the last 50 candles was at this level. When this candle was forming, the average price over the last 100 candles was right here, because this little red one is my indicator for 100 daily average. So it's all really simple. If you use other types of moving averages, they'll just calculate the price differently. Some candles will be given more weight than certain others from the past. Pay attention to the description, there will be a link to register on the Bybit exchange. This is the #1 exchange that I personally trade on, and it's the top one in terms of trading volume, liquidity, and it has the lowest fees. Just from this, you'll save around a few $100s every month. And why do I recommend registering specifically through my referral link in the description? With it, you'll get a cash bonus for registration ranging from $10,000 to $30,000, depending on the size of your deposit. Most of my subscribers get $100, but if you don't have any deposit at all, you'll at least get $10. If you're a big trader, the good deposit, you can get up to $30,000. But for larger amounts, you'll need to reach a corresponding trading volume. On this page, click here and you can see what bonus you'll get for registering. The link is below. Enjoy watching. So, a regular simple moving average gives each candle the same weight and just, roughly speaking, adds up all the closing prices and divides by the number of candles. So we divide all the closing prices by 50 and that gives us the 50-period moving average. What do they give us? How do they help us? First, determine the direction of the trend. You can determine very early when the trend is changing. If the price is dropping like this, dropping, and then it kind of hangs around for a while, and we see that our moving average is right here, well, let's say it was going like this, and suddenly our price is on the moving average. This already indicates that the price before this was falling, and was at a level lower than the average for some period in the past, and now it is already at a level higher than for some period in the past. Technically, if a new trend hasn't started but the price is above the moving average, it's a good sign. The signal strengthens with a longer moving average interval. But purely technically, just so you understand, when it seems like a new trend hasn't really started yet, but the price is already above the moving average, that's a good sign. The signal will be stronger the longer the interval of that moving average. So if we see the price crossing the 50-period moving average, there it is at E50. You see the price is just slightly crossing over, just a little bit. That's not very significant. Well, ideally it should also hold above, right? Not just cross over, because it might not hold and could pull back. So let's say it crossed over and held above the 50, but then it shot back down. So that has little significance. It's much more significant if it crosses above the 100-period moving average. And even more so if it crosses above the 200. See, it crossed above the 50. There was actually a false signal here. The price dropped significantly. It crossed above the 100-period moving average. Well, even though it didn't shoot up as fast as possible, the downward trend has already stopped, as you can see. Crossed 200, 100, no trend. It crossed over. It did pull back a bit, of course, but then it went up. So, you see, once it crossed above the 100, there was no more downward trend. This helps to identify a change in trend. It's not a fact that it will definitely change to the opposite trend. It could maybe shift to a sideways trend, but the fact remains, shorting here is questionable and probably not worth it. That's the first point. Second, if the price is approaching the level of the moving average, meaning it's coming from below, and the moving average is gradually getting closer, and the price is getting close to the moving average level, this means that there's a high probability it will bounce down, that the moving average will act as a horizontal level. That's how it works, because bots mainly place their orders near the moving average. If a person or a bot bought somewhere down here, well, where should they take profits? Where should they sell? Well, the level is somewhere far away, for example. Here, well, why lock in profits at some unclear level just for a tiny gain? So, moving average is the reference point, and the larger the interval of the moving average, the better it will work as a level. And just like that, if there's no bounce, and the moving average is broken, it acts as a level break, and an impulse with a trend acceleration can start, especially if this happens on high volumes. So, moving averages act like levels, and the stronger they are, the larger the interval they show. Well, for example, here's the same chart. We have a sideways movement here, a trend change that we saw when the price broke above the 100 moving average from below. Look, it pulled back down again and is trying to get close to that 100, and they're selling off from it. Do you see? This is where they start selling off. As soon as it settled, that's it. There's no more seller from the 100. It bounced. And where did the seller start? Near the 200. Where did the buyer start after the sell-off? Near the 50, near the 100. So you see, it's like moving from one moving average to another. From one moving average to another, it broke. A retest later. Where did it go? To the level of this horizontal one? No. Look. The retest happened up to the 200 moving average. For those who don't know what a retest is, after a breakout, if the price returns to a sort of mirror level and bounces off it, that's a good entry point. It's called a retest. Well, you see the 200 period moving average, it broke through, we had a retest of the 200, and then we bounced off and took off. Well, I'm not even mentioning that even in a good trend, even the smallest moving average will act as a level from which people will sell. Here it is, a good trend, and you can see sales are starting right from the 50-period moving average. No sales at first, i.e. the buyer is buying back. After the impulse, there's a pullback in the trend, and a new impulse starts. The moving average is right here. There was a small stop run, but still, you see, there are a lot of points here where sales start. Not from here, but specifically from the moving average. It's the moving average, it's the moving average. There was a small stop run, but anyway. Here's the moving average. This is where the trend starts to change. And there, also went in at 100. And that's it. The trend has changed. Well, you can even see it. You can draw a trend line. The trend has changed. And that's it. Don't need to sell from the 50 anymore. But you could trade in the trend. So you see, first of all, you can understand the direction of the trend and the timely changes in the trend. You can trade from levels, from moving averages. And the moving averages themselves also give signals about entry and exit points in trades. Well, for example, the price is somewhere out there. It doesn't matter if it's up or down. Maybe a situation like this happened, and the moving averages look something like this, and they cross each other at certain points. When the moving averages cross each other from top to bottom, it's a signal of market weakness. When they cross from bottom to top, it's a signal of market strength. Also, these crossings are called a death cross, when they cross from top to bottom, meaning the death cross. And the golden cross, which is when they cross bottom to top, It's a good signal, and the stronger it is, the longer the period of the moving averages we take. So if the 50 crosses the 100, that's a weak signal. If the 100 crosses the 200, that's strong signal. And let me show you, for example, how it works, where it won't work, because it doesn't work everywhere and all the time. In particular, it doesn't work in sideways markets. So we have a sideways market here, and just because of the definition of a sideways market, the price keeps bouncing back and forth in one place. So the moving average, no matter which one we take, will constantly cross each other. It doesn't work. A sideways market. It works in some trends, then there might be a sideways market, a trend change, and then again some trend change. And in these situations, it will work. Let me show you some strong signals. By the way, during vertical spikes, like we have a lot of vertical spikes right now, it's clear that they will show everything with a delay. And buying right here would also be a mistake. So, first, there shouldn't be a sideways market. And second, there shouldn't be any vertical movements. There should be something in between a sideways market and a vertical spike for the golden cross and death cross to show a good signal. And, by the way, just like with any other patterns, just like with any other setups, the higher the time frame we work on, the better and clearer these signals will be. Let me show you, for example, on Bitcoin. It hasn't been moving as sharply as altcoins lately. So look, there was some kind of upward vertical trend, then a sideways market, and the crossing of these moving averages in the sideways market, they start crossing each other back and forth constantly, and it doesn't work in a sideways market. Where's the sideways market? Here's the upper boundary of the sideways market, and here's the lower boundary of the sideways market, plus there's a small channel here. And when we exit the sideways market, that's it, we've come out of the sideways market. What happens? Now we're looking at the moving averages, and there it is. The 100 crossing the 200. So even if you got stuck somewhere or missed the entry point, you see that the moving averages crossed each other, and you understand that you need to enter. You need to enter in the direction of the crossover. But the only thing is, yes, there was still a vertical spike here, and the price had already taken off by the time these moving averages crossed. But the larger the gap between the moving averages, the better the signal. You can look at shorter moving averages. There will be more false signals, but will be able to react much faster. Well, for example, here the golden cross happened in a good spot. We haven't come out of the sideways market yet, but we've already exited this flag pattern, and there's been a golden crossover. This is one of those signals paid attention to when I last went long on Bitcoin and gave you recommendations. So I was looking at that too. I looked at a combination of factors: the bullish engulfing, the retest, the breakout from the flag, the volumes, and the golden cross as well. Yeah, it's a bit weak, but it adds to the strength of confidence in the trade, I guess. And yes, you can trade only based on moving averages, but you definitely shouldn't if you don't have experience, especially moving averages are just a good index. An indicator, in addition to your trading strategy, helps you read the market better, understand the market better, navigate entry points better, find exit points better, and grasp the direction of the trend, whether it's strong or weak. Well, it's clear, right? I didn't mention it before, but if our moving averages are pretty flat and the price is shooting up or down vertically, then it's obvious that the trend is super strong, and you can draw certain conclusions. You can find out when a super strong trend shifts into a weaker state, and yeah, there might be some kind of pullback forming soon. You can also develop some strategies around that. And moving averages help assess the market situation. And very well, so well that I only use moving averages as indicators. Of course, I don't just use indicators. I rely on technical analysis as a whole, but when it comes to indicators, I only need those. If you subscribe to my Telegram channel, there's a pinned message to the free mini training on trading. 3 lessons, and the 4th one will be a live stream coming up soon. Come on in, subscribe to the channel, and learn. Good luck,